Welcome to Trading Nation. I'm Eric Chemi. Stocks getting hammered as global growth fears hit Wall Street, but our next guest is not veering away from his bullish case for stocks, and he believes next week's Fed meeting could help stabilize the markets. Steve Chiavarone manages the Federated Global Allocation Fund. Welcome to the show, Steve.
How you doing, Eric?
All right, so what could the Fed say next week to calm the markets? Because so far, everything that when you get involved with the Fed, it just brings more uncertainty and more volatility.
Well, it's going to take more than the Fed, I think, for markets to move higher, over the longer run. But I think in terms of next week's meeting, we got a hint that the Fed is moving in a more dovish direction, and they softened their tone with Powell's speech, about a week ago. But we need to confirm that his view of dovishness is the same as the market. So I think the market is looking for the Fed to hike in December and then be in wait-and-see mode as we move into 2019. He may have two hikes in mind, December and March. And so I think we need to get a little bit of clarity on that. If it turns out that it's just the December hike and then we're in pause, wait-and-see mode in 2019, I think that'll provide some comfort to the market.
Why do you believe investors should not be pricing in a recession?
Because none of the indicators of recession have hit. If you look at the economy, you have across the board, GDP growth is growing, at or above trend. Unemployment is sitting at multi-year lows. Spreads remain tight. Labor market indicators remain fine. Inflation remains benign. The Fed is closer to pausing than getting aggressive. We don't have any of the early signs of recession, yet we've got a market where despite 20% earnings growth, the PEs have fallen 20%. What that tells us is the market's pricing in recession in 2019. We just don't think that's going to happen. We think at worst we're going from 3% growth to about 2.5%.
So if you don't think there's a recession, and let's say this year, call it a 0 year,
sure,
closest round number, what does next year look like for the markets?
We think it's volatile, but we think it ultimately ends up in a positive direction. So we think markets will march towards the 3,100 target. That's a long-held target for us that we've had to push back a little bit. It basically goes something like this. If the fundamentals of the economy are strong, which they are, and the fundamentals underlying the market are strong, which they are, there can be periods of volatility that can be, let's call them distressing. But eventually those fundamentals need to win out. And so we think that you're going to have volatility in the market until we have some more clarity on trade, until we have a sense that earnings and GDP growth are slowing but not going into recession, until we have some certainty around the Fed. Once we get through that volatility, and it's anyone's guess on how long it's going to take, we think markets can move higher, on the backside of that.
Obviously, we know these forecasts are not perfect. What's your confidence on a scale of 0 to 10 of how confident you are, and what's the biggest risk to your forecast maybe going awry?
Yeah, I think you have to start with the idea that we are, in our industry, stewards of capital, right? We're managing other people's money, and so we need to put the odds in our favor. Our best analysis, as we look at markets and as we look at the economy, is that things are stable, that you have strong economic growth or solid economic growth, earnings are growing, and fundamentals remain solid. And so in that environment, our confidence in being overweight or in being bullish is relatively high. In the short run, however, given that we've broken below some key technical supports, we have to be cognizant that there's some downside. So where we were 11% overweight equities in the summer, we're closer to 3 or 4% overweight equities now in recognition of that. So we're confident where markets are going to go over, we think, the next 12 months. We're uncertain as to whether or not we're bottoming here or we have some more downside to go before we resume that up move. Biggest risks, I think, is if trade continues to lag. There was a lot of confidence that was given to the market from the tax deal that allowed folks to start to invest. I'm talking about companies. The uncertainty around trade is making them difficult to do that, and we need companies to invest so we can increase productivity and allow growth to continue.
Steve, appreciate the insights.
Thanks so much, Eric.
Thanks for coming on Trading Nation. That was Steve Chiavarone. And thank you for watching Trading Nation. I'm Eric Chemi. We'll see you next time.